How much house can you really afford? That, my friends, is the million-dollar question, isn't it? Welcome to our exploration of the crucial topic of house affordability. As we delve into this journey, we'll touch upon the importance of understanding just how much house you can comfortably afford before you step foot into the exhilarating world of home buying. It's a common misstep to fall in love with a property only to realize it's beyond one's financial reach. The heartache of such a scenario is something we'd all prefer to avoid, wouldn't we? Taking a moment to assess your buying power doesn't just ensure you're looking at homes within your budget, it also brings you one step closer to finding your dream home. So, let's embark on this journey together, shall we? Stick with me, and by the end of this video, you'll have a better understanding of your buying power. First things first, let's take a good, hard look at your income. Now, why is that important, you might ask? Well, when it comes to buying a house, your income plays a pivotal role. It's the bedrock upon which all your home buying plans are built. You see, your income is essentially your financial horsepower. It's the fuel that powers your ability to meet mortgage payments, and it's the first thing lenders will look at when deciding how much they're willing to lend you. But not just any income will do. Lenders typically look at your gross income, that is, your income before taxes and other deductions. This is because it gives them a clear picture of your total earning potential. However, it's not just about how much you're earning. Stability is key. Lenders love stability. They want to see that you've had a steady income for at least 2 years. Why 2 years, you might ask? It's because this shows them that you're less likely to run into financial trouble in the near future. So, if you're thinking about changing jobs or starting a new business, it might be worth waiting until after you've secured your mortgage. Remember, lenders are risk-averse, and a sudden change in your income situation might make them think twice about lending to you. But what if you're self-employed or have multiple income streams? In such cases, lenders will typically take an average of your income over the past 2 years. So if you've had a good year followed by a not-so-good year, don't worry. It's the average that counts. Now let's say you've got your income all sorted out. You've got a steady job, your gross income is looking good, and you're ready to buy a house. What next? Well, it's important to remember that your income is just the starting point. There's a lot more to consider when figuring out how much house you can afford. Remember, your income is just the starting point. There's more to the equation than that. So stick around as we delve deeper into the world of mortgages and home buying in the next scenes. Buckle up, it's going to be an enlightening ride. Now let's shift our focus from what's coming in to what's going out. Yes, we're talking about debt. As much as we'd like to ignore it, existing debt plays an undeniable role in determining how much house you can afford. Lenders aren't just interested in your income. They're equally concerned about your debt-to-income ratio. This ratio, my friends, is the percentage of your monthly gross income that goes towards paying off debts. The lower the ratio, the better your chances of securing a mortgage. So why does this ratio matter to lenders? Well, it's simple. They want to be sure that you can comfortably handle your mortgage payments along with your existing debt obligations. If your debt-to-income ratio is too high, lenders might think you're more likely to default on your mortgage. Your debt isn't necessarily a deal breaker, but it does play a significant role in how much house you can afford. So, we've covered income and debt. Now, let's talk about the money you've been squirreling away for your down payment. Imagine the down payment as the welcome mat at the door of your new home. It's the first significant financial step towards home ownership. But why is it so crucial? Well, the down payment serves as your initial investment in the property. It demonstrates to lenders that you're serious about this purchase and are willing to put your own money on the line. The size of your down payment can significantly impact the affordability of your house. You see, the larger your down payment, the smaller your loan amount needs to be. This can mean lower monthly payments, potentially saving you thousands of pounds over the life of the loan. Now, it's tempting to think the bigger the down payment, the better, right? Well, not always. While a hefty down payment can reduce your mortgage payments, it's important to strike a balance. You wouldn't want to drain your savings account completely to make a larger down payment. Remember, home ownership comes with its own set of unexpected expenses. You'll want a cushion for those rainy days or those unexpected boiler repairs. Also, keep in mind that there are various mortgage programs out there that don't require a whopping 20% down payment. Some programs cater to first-time home buyers and offer options for lower down payments. It's worth exploring these options to find the best fit for your financial situation. So, what's the takeaway here? A down payment is a critical part of the home buying process, and its size can directly affect your mortgage affordability. However, it's essential to consider your overall financial health when deciding how much to put down. The more you can put down, the more house you can afford, but don't empty your savings account just yet. And remember, buying a home is not just about the numbers. It's about finding a place where you can build memories, a place you can call home. All right, moving on to the next piece of the puzzle, mortgage rates. These are the interest rates that lenders charge on your home loan. They're more than just numbers, they're pivotal factors that determine the overall cost of home ownership. Imagine mortgage rates as the cost of borrowing. The higher the rate, the more you pay to borrow the lender's money. Conversely, the lower the rate, the less you pay. Thus, even a slight variation in mortgage rates can significantly impact your monthly payments and the total cost of your home over the loan's lifetime. Now, there are two main types of mortgage rates: fixed and variable. A fixed-rate mortgage means the interest rate remains the same throughout the loan term. This type of mortgage may be a good choice if you prefer certainty and stability. You can budget confidently, knowing your interest rate and monthly payments won't change. On the other hand, a variable or adjustable rate mortgage fluctuates over time. These rates are typically tied to a benchmark interest rate, which changes based on economic conditions. While this might sound risky, there's a silver lining. If interest rates decrease, so do your payments. However, it's a double-edged sword, as rates can also increase, leading to higher payments. The choice between fixed and variable rates often comes down to your risk tolerance and financial situation. If you're comfortable with the possibility of rates and payments changing, a variable rate might be a good fit. But if you value predictability and want to know exactly what your payments will be, a fixed rate could be more suitable. To sum it up, mortgage rates are a key factor in determining the affordability of a home. They influence both your monthly payments and the total amount you'll end up paying for your home. Therefore, it's crucial to understand and consider mortgage rates when planning to buy a house. Mortgage rates can make a big difference in your monthly payments, so don't overlook them. So we've covered a lot of ground here, haven't we? Indeed, the journey to understanding just how much house you can truly afford is a winding road fraught with many variables. Let's take a moment to summarize the key points we've delved into. Firstly, we explored the importance of understanding your income. Knowing what's coming into your bank account each month is the foundation of this process. It's from this figure that we can start to carve out a realistic budget for your potential home. Your income sets the stage and gives us the first indication of the house price range you can afford. Next, we ventured into the realm of debt. As unpleasant as it may be, it's a crucial factor to consider. The amount of debt you carry can directly influence the mortgage amount you'll qualify for. It's vital to be realistic about your debt, acknowledging it, and factoring it into your calculations. Then we moved on to the topic of down payments. This is where you can start to see the dream take shape. The larger your down payment, the less you'll need to borrow, and the more affordable your home becomes. Remember, every pound saved is a pound less you'll need to repay with interest. Finally, we discussed the role of mortgage rates. These pesky percentages can have a significant impact on your monthly payments and the overall cost of your home. It's essential to shop around and consider your options before settling on a mortgage rate. In conclusion, determining how much house you can afford is a careful balancing act between your income, debts, down payment, and the mortgage rate. It's a complex process, but with careful planning and consideration, you'll be well on your way to finding a home that fits your financial capabilities. Remember, buying a house is a big investment, Make sure you know exactly what you're getting into before you sign on the dotted line.